Hello and welcome to this HL webinar special on the upcoming budget and what it could mean for your money. I'm Claire Sinton, Financial Wellbeing Lead here at Hargreaves Lansdown, and I'm joined by three of Hargreaves Lansdown's finest. I've got Sarah Coles, our Head of Personal Finance, Helen Morrissey, our Head of Retirement Analysis, and Bradley Clark, one of our Chartered Financial Planners. Morning all.
Good morning.
Morning.
Thank you for joining us. So this is Labour's first budget in over 14 years, and the new government is looking to find a significant amount of money with a £22 billion black hole in the public finances. However, while speculation is rampant, the budget isn't taking place until the end of next month. So though we know change is coming, actually there is no certainty as to what that change will be at the moment. However, this next month or 4 to 5 weeks really is your window of opportunity to make no regrets moves to take advantage of the existing rules. So this discussion will last for around 40 minutes. Please do bear in mind that everything discussed is information, it is not financial advice, that everyone's circumstances will vary, and what we discuss might not equally apply to everybody. So having said that, that's the housekeeping out of the way for today. So let's kickstart the discussion, Helen, by coming to you first. So this is Labour's first budget in over a decade, and the rumour mill is in overdrive. So at this point, what do we actually know?
Okay, so we do know a few things already. They have kind of been quite clear that they're not looking to make any changes to things like, income tax, national insurance, VAT, etc. However, what they have said, there's been various things around, any changes kind of, affecting those with the broadest shoulders. So that has kind of led to a lot of speculation around what does that mean for higher earners. They've also said stuff about, supporting hard-working families, which, also opens that Pandora's box of, what might that mean for, for pensioners. And we've already had a little bit of an insight into that, and obviously that recent announcement around the winter fuel allowance and how only pensioners with pension credit are going to get that winter fuel allowance. And obviously this hasn't gone down very well. And we're just kind of waiting to see that, if there are going to be any further changes affecting pensioners. And, obviously the concern there is as speculation rises, people might rush out, they might panic, and it could lead them to do things that they might come to regret further down the line.
Absolutely. So there are lots of rumours, Sarah, and actually quite a lot of perhaps scaremongering in the press. We've heard that term, those with the broadest shoulders, and we know that the winter fuel allowance has been removed for pensioners. So how should people approach the rumours that they're seeing?
So I think what Helen said about panic is really key. So when you're hearing all these rumours, especially when they've gone on for so long, because I think, they started right back during the election campaign, and we've had all of the potential rumours, and they've sort of grown over time, and there has sort of become this tendency for people to say to the government, do you think that such and such will change? So they are randomly picking any old tax. You could pick tax on crisps. So they say, do you think the tax on crisps will happen? And they'll say, this isn't the budget. I'm not going to tell you off the top of my head. And then they've got a story. The story is, Chancellor refuses to rule out tax on crisps. So as a result, we've had all of this speculation. And the really important thing is not to panic. So if there was something that was not right for you before all of these rumours started, it's still not right for you now. So really just don't rush into making any sudden moves. One of the really interesting things is out of all of the talk of all of the taxes that we don't know whether they're going to happen, there is one change to taxes that definitely will, which nobody's talking about, which nobody talked about during the general election either, and that's those frozen income tax thresholds. So they've been frozen now for such a long time, and they're still going to be frozen next April and the April after. And as a result, it means that if you get a pay rise, then you'll be paying more of your pay rise in tax, and it could take you over a threshold into another rate of tax. So it's the not talked about tax, which is the one that we definitely know people will be paying more of. And I guess the other side of things is that whilst it's important not to panic, it's also, as you say, this sort of window of opportunity where there are some things that you can sort of think, well, have I paid into my ISA this year? Does that make sense for me? Can I make the most of it? Similarly with pensions. So there's a variety of different things that you can sort of sensible sort of moves that make sense regardless of what the government does that are definitely worth looking at now to see whether they're going to be right for you.
So a couple of things there. No knee-jerk kind of reactions, really think long-term and whether it works for your finances. And the second is things might be changing. We have no certainty over what those changes will be yet, but actually be mindful of what's perhaps going under the radar, which has already changed, like those increasing income tax thresholds because they've been frozen. Labour have made no secret about the fact that this budget could be challenging, using terms like painful, but also saying that things might get worse before it gets better. So what can people do now to minimise really the impact of any potential changes?
So there are a few things. So I sort of mentioned the sort of, those sort of no regrets moves. I mean, I think, it's worth kind of looking at what sort of taxes might get affected. And Helen mentioned there's lots of talk about working people aren't going to have to worry about anything. So then it becomes a question of whether it's going to be some sort of wealth tax. Now, we know that a new wealth tax has been ruled out. So it's going to be questions around whether there's going to be any changes to existing wealth taxes, which are things like capital gains tax and inheritance tax. Now, if you're worried about capital gains tax, which you'll pay on and things like stocks and shares, then actually stocks and shares ISAs can be a very useful place to put your money. And if you've got money outside a stocks and shares ISA, you can transfer it in if you've still got your allowance for this year. So you can put £20,000 worth in this tax year. Similarly, with inheritance tax, there are steps that you can take in order to sort of look at your inheritance tax and whether or not you can mitigate it. So things like gifting during a lifetime can be absolutely key. So there are some sensible things you can do, but the overriding message is not to panic, not to rush into anything at this stage.
It's a really good segue to Bradley, who, as a financial advisor, you offer an extra helping hand to those who perhaps don't feel confident making their own decisions. So are you seeing an increase in client contact at the moment?
Yes, certainly. It's really common to see an increase in contact before any budget. For me personally, this time round, there's been a big increase in contacts, and that contact has come a lot earlier than it normally does. I've been speaking to clients about the budget already for the last 4 or 5 weeks, and we're still, I think, 4 weeks away. I think that makes sense because there's a change in government, there's a lot of rumours in the press as well. And it's interesting that the contacts I'm getting it's not just from my existing clients who I work with already and we speak on quite a regular basis, but it's contact from clients who I've perhaps worked with on a one-off basis in the past who are getting back in touch, and lots of new clients are getting in touch as well. So I think it goes to show that this budget really is important to people, and it's something that a lot of people are thinking about.
And from those discussions with clients, are there common challenges?
There are. You tend to find that the challenges are always fairly similar, and pensions often comes up. This year is no different. I think that makes sense because pensions for a lot of people, particularly those who take advice, are the bedrock of their financial plan. And if pension changes are negative, then particularly if you're approaching a big milestone such as retirement, then it is very daunting. The areas in particular around pensions I'm getting a lot of questions on, twofold really. The first is tax-free cash. Will it be reduced? Will it be removed perhaps? And the other is tax relief. So those who are still in the accumulation phase are concerned about tax relief perhaps not being as attractive in the future as it is at the moment.
Lots of questions on pensions, and we'll be putting some of those to Helen shortly. But in terms of those, I suppose, discussions, how can advice really add value around, significant periods of perhaps fiscal change and significant fiscal events?
Yeah, so I think the main thing that an advisor can bring to a client is perspective. I think it's really helping clients cut through the noise, and there's a lot of noise out there at the moment. It's easy to see a negative headline and immediately assume the worst, particularly if you are approaching a big milestone. But in my experience, it's those who don't have a plan in place, don't have a strategy in place, they're the ones who seem to worry the most. So I think where advice can be really helpful is in firstly creating a plan and really helping you identify what's important for you, and then putting in structures in place to achieve that, and then also allowing that plan to be maintained and reviewed over time. Any plan should be reviewed typically annually, but also when things like a budget come up, it's good to have a plan there.
So really reiterating what Sarah mentioned earlier, no knee-jerk reactions, and also really thinking about the longer term and how that fits into your broader plan.
Yeah, absolutely.
Sarah, coming back to you now. So we've already mentioned a couple of times that Labour have made it clear that it is those with the broadest shoulders who should face this greater burden. What are the risks that are facing higher earners now?
Well, I think, the vigorous risk of saying the same thing, but the real risk is that we panic, because there's so many rumours, and it all sort of comes down to whether or not it's going to be taxes on wealth, and there is the risk that will encourage people to make mistakes. Really, the kind of the main things are centring around capital gains tax and inheritance tax. But it is worth saying that some of the fears that people have about inheritance tax, for example, are not necessarily the things that might change. So, for example, I've had a lot of people say to me, will I have to pay inheritance tax? And these people might not have, more than £1 million worth of assets, which is sort of, at the moment, is what will protect them from inheritance tax. And they're quite worried. They'll say, what should I do? Should I give it all away now? And actually, the question is, will that necessarily change? Will the government necessarily change the amount of money that you can give away without paying inheritance tax? If it does, will it necessarily change it right now, or will it leave you till the end of the year? And again, if it does make a change to that, will it move it miles? Because one of the things, as Helen said, when that change was made to the winter fuel payment, there was a huge backlash because it affected so many people. Well, that movement in the inheritance tax threshold will take it being something that only 1 in 20 people have to worry about to being a lot more than that. And that would be incredibly unpopular. So there's an awful lot of hurdles that the government would have to overcome in order to make that one change that everyone's very worried about. Meanwhile, there's a ton of stuff on the table about inheritance tax. There's loads of different rules about loads of different exceptions and different people who don't have to pay as much inheritance tax as others. And those could be tweaked or moved around slightly and would raise money for the government without having such a big impact and worrying so many people. And there is a really good chance that actually the changes that are made aren't the ones that you're necessarily worrying about and trying to plan for and think about. They could be something completely different and actually a lot less scary. So really overall, if you're a higher earner, yes, wealth does look like it's in the frame, but don't panic that it's necessarily going to affect you, because it really might not.
Brilliant. And we're going to come back to both capital gains tax and inheritance tax in a few minutes' time. Helen, coming back to you now, since the budget was announced, what trends are we seeing emerge from our client data?
So we are seeing some really interesting trends emerge, and we've seen kind of quite a big increase in people maxing out their annual allowance on their SIP, for instance. I mean, that's up around 70%. We've also seen increases in people making the most of their stocks and shares ISAs. I think also the junior ISAs as well. So these are examples of really good, no regrets moves that people can make to build their financial resilience. So that's kind of, great to see. However, the challenge is that this is all set against this backdrop of people really fearing change. And, what we always, try and say is that, for the government, they've got, the recognition needs to be that pensions are a long-term game, and we need a long-term approach to pensions policy that enables people to save for the future without worrying about being tripped up by tax changes down the line.
Really good news that people are kind of seeing the value in those annual allowances where they benefit from that tax-free kind of growth and tax-efficient shelters. Pensions could be targeted by Labour. In the year 2022-23, the receipts for tax relief totalled more than £27 billion. So it's an area where a significant amount of money could be recouped. What potential changes could Labour make?
Yeah, so it's a really, really interesting question, actually. So, as you say, the amount of money and receipts around tax relief are enormous, and around 56% of tax relief is given to higher rate taxpayers. I think it's about 7% for additional rate taxpayers. So there's wiggle room here where money could be saved. Now, there's been a lot of discussion around whether we will see a move towards a flat rate of pension tax relief. So that could be 20% or it could be 30%. And in the run up to the election, there was a lot made of old comments that Rachel Reeves made way before she became Chancellor, where she did say that she supported a move to a flat rate of around 30%. Labour have said that is not their current policy, but as you say, we could see a change in that direction. Now, what does that mean? Well, if we saw a shift to 30% tax relief, that would be good news for a basic rate taxpayer, because at the moment, they get tax relief at their marginal rate, which is 20%. So if they were contributing £1,000 to their pension, that would currently cost them £800. Now, if we move to this 30% tax relief, that £1,000 contribution would only cost them £700. So that's good news for them. However, if you then look at higher and additional rate taxpayers, they're used to getting tax relief at 40 or even 45%. So a shift to down to 30 would not be such good news for them, and you could potentially see them looking to contribute less to their pensions as a result, which wouldn't be good news.
So a flat rate could be beneficial for basic rate taxpayers, but very disadvantageous for any higher
Yes.
rate taxpayers. Sticking with pensions, because there's been lots of questions on pensions, unsurprisingly.
Absolutely.
Tax-free cash is an area that's attracting a lot of the media spotlight, raising concerns that Labour could remove that popular tax-free perk. How likely do we think that is? But also, actually, what considerations do people need to know before acting?
Okay, so I have covered many budgets in my career, and tax-free cash is always comes up as a pre-budget rumour. Now, I can't even begin to tell you how unpopular any moves to restrict this would be, because even though a lot of people will say that they don't understand pensions, they do understand the tax-free cash element because they have plans for it. You know, they may be looking to use it to help them pay off their mortgage, for instance. And so any kind of moves by government to kind of, you know, row back on that would, you know, I can't convey how unpopular I think that would be. Now, I mean, what I would kind of say is, you know, there's a worry there that people would be concerned about it being, you know, rolled back on, and that could force them to maybe feel like they need to take it now, and that could actually give them real challenges in the future, because, you know, what are they going to do with it? We always say, if you're going to take your tax-free cash, you've got to have a plan for it. Don't just take it out of your pension and then put it in a bank account where it's getting, you know, a really poor rate of interest, for instance, where it, you know, its purchasing power could be eroded by inflation. Or you might just find that you end up nibbling away at it over the years, and you kind of effectively fritter it away, rather than kind of, you know, putting it to really, really, good use. So, what I would say is, you know, don't make any kind of rash decisions. You know, if there were any changes to tax-free cash, you know, the likelihood would be that there need to be some kind of transitional measures put into place, because it will be a big change to happen. So what I would just say is, you know, don't panic. You know, don't look to, make these knee-jerk reactions that you could come to regret.
I think just drawing out one of the first points you made there about the fact that people understand how the tax-free cash element of pensions work, and that's kind of typically the key understanding of pensions. The new government would really need to consider, if they change that one ruling, what impact that would have on engagement with pensions generally. Because in research that we've recently done with our workplace audience, we asked them what words they'd associate with pensions, and it was murky, complex. So if they're then having to add in another level of transitional arrangements in order to facilitate that, it's adding that extra layer of complexity. Bradley, for higher earners who might be concerned about a flat rate of tax relief, what can they do now in order to act and kind of maximise their pension allowance?
Yeah, I think it's worth starting by reiterating what I think all three of you have said, which is don't panic, don't make any decisions that haven't been properly thought through. Having said that, there are opportunities, and with particularly higher earners, what you could look to do is bring forward any plans that you've got for making a contribution. So using your annual allowance perhaps sooner than you perhaps would. If carry forward is something that's available to you, then by all means look to do that. We've got a great carry forward calculator on our website. Put in some details on there, and it'll tell you what your potential is for that. And also, if you're married, then you can, if you've got a spouse who perhaps isn't working and hasn't contributed to their pension, you could look to contribute to theirs as well. But it's important that any decision that you make fits in with your wider plans, and also what you don't want to do is take some action now that perhaps hasn't been properly thought through, that could end up causing you problems when you're trying to solve a problem that might not be a problem. You know, tax relief may not be changed in the budget. And I've got an example of this where this in real life has happened. So this was a colleague of mine, another advisor here at HL, and they had a client who is currently in a very fortunate position where they're contributing £5,000 per month into their pension. This particular client is getting towards the end of their accumulation phase before they move into retirement, so their number one goal is funding their pension and trying to retire as soon as they can. The discussion that was had with the advisor in light of the budget was one where, rather than perhaps continuing to contribute £5,000 per month, I think we're 5 or 6 months into the tax year, so that's 25 or 30,000 that's gone in. Why don't they bring forward that contribution, make a lump sum contribution now, and then cease the £5,000? So what you're doing there is you're securing the tax relief whilst you know what the rules are. The actual outcome is the same. The plan was to fully fund the pension, and it fits in with your objectives. You're just bringing that forward. But there is a big caveat there, which is this only works if you can afford to do that. What we don't want to see clients doing is Perhaps if you've got cash as an emergency fund and you think I'm going to get all of that into a pension to benefit from relief now, just in case it changes, we don't want a position where you then are left with no emergency fund and something happens like, I don't know, your boiler goes or your car breaks or you need some money quickly. Of course, once it's in a pension, you can't get it out. So I think it's a good example of where there are opportunities to do things now in advance of the budget, but it has to fit in with that wider plan.
And that wider plan is, of course, having those key foundations in place, so ensuring you've got that emergency fund before you then look to lock up money and perhaps invest it for a longer period of time. So we're going to leave pensions there for a minute. And Sarah, we're going to move on to capital gains tax, which you've already touched on briefly. It's often considered a tax on the wealthy. So there's been a fair bit of speculation that there could be some changes to capital gains tax within the budget. Can you remind us all how capital gains tax works and what it typically applies to?
Yes. So if you kind of look at it in the basics of capital gains tax, is that it's a tax on profits. So that might be profits that you've made on stocks and shares, or it might be on property. And so that capital gains tax will be charged on whatever gain you've made. And the point at which it gets charged is when you realise that gain. So it might be when you sell up. If you've got sort of a portfolio and you're sort of selling and buying shares all the time, then you are realising capital gains taxes capital gains along the way. It doesn't all just sort of happen at the end when you leave your investments. It also happens if you give money away to anyone other than a spouse or a civil partner. And that's why when people are talking about capital gains, they don't say tax on profits when you make them. They say it's when you crystallise that gain. So it's a very weird term, but it's basically in order to sort of catch both of those two things. So if you are subject to capital gains tax, then the amount you pay will depend on your income tax rate. So if you're a basic rate taxpayer, then on stocks and shares you'll pay 10%, and on property you'll pay 18%. If you're a higher or additional tax rate payer, then on stocks and shares you'll pay 20%, and on property you'll pay 24%. So that's sort of the basics of capital gains. There's two other things that's worth knowing about. One is that each year you have £3,000 that you can make before having to worry about tax. So that's kind of your annual allowance. And one of the ways in which people manage a capital gain is to make sure they're taking advantage of that every year. The other thing to know is that at the moment, capital gains tax resets on death. So if you've made a big gain on, an investment property or something, then if you were to pass that to a child or pass that to anyone else, then they don't have to pay the capital gains tax on that. There might be other taxes, but there's no capital gains tax. So that's a really important part of the function, which is why a lot of people will sort of hang on to gains because they don't want to have to pay them, so they leave them until they pass away. One of the other things that's worth knowing about capital gains tax is that it gets offset against your losses in any year. So you might have made a loss in the year. So when you're putting together your self-assessment tax return, if you've made a loss, make sure you claim it in that year, because then you can carry it forward for 1 year and offset it against gains in the next year. But you have to have done that in your tax return at that point in order to be able to carry it forward. So often you'll think, oh, it's a loss, I don't have to worry about tax on it. No, but you can take advantage of it. So it's definitely worth making sure that you make that claim.
It's a really key nugget there, I think, that lots of people will be taking down. The other thing that I want to mention about capital gains tax is that with the allowance, that has been significantly higher in previous years. So it's decreased from around £12,300, it's halved to £6,000, then it's halved again to £3,000. So it's something that has been kind of changed relatively recently. What potential other changes could Labour make?
Yes, it seems unlikely that that's going to get touched again, given how much it's fallen. So the rumours are sort of circulating around two things. Again, always have to say they are just rumours. It might be the case that neither of them happen. So one of them is a change in the rate of capital gains tax. And one of the things that people have talked about is the potential for that to match your income tax rate. Now, that would be a massive increase. So if you're looking at a basic rate taxpayer who's currently paying 10% on stocks and shares, suddenly that would be 20%. So that's a doubling of the tax rate. Again, for high rate taxpayers, we go from 20 to 40, so that's a doubling. And for additional rate taxpayers, it goes from 20 to 45, which is even worse. So it will be a massive increase, and it would be a really big blow for investors. So it's questionable as to how likely that is, but it's one of the things that's been rumoured. The other rumour is that rule I said about capital gains tax dying with you. That's been questioned as well. So there's sort of people considering whether or not capital gains tax might be charged on death as well. Again, they are just rumours, but if you're worried about them and you haven't yet taken advantage of that £3,000 allowance for this year, then there is a window of opportunity to take that £3,000 and to reduce your capital gain, so that if there are any changes coming down the line, then you've done what you can to protect against them.
Brilliant, thank you. Bradley, how would you advise a client to take advantage and really minimise any potential capital gains tax?
Yeah, so there's all the things that Sarah's just mentioned that you can look to do. So using your ISA allowances and pension allowances, and you can do that every year. Using the CGT exemption, as Sarah's just mentioned, it's £3,000 per tax year. You get that every year, and you can use that. If you're married, then you can transfer assets between spouses, and then use your spouse's CGT exemption as well. So that's something to bear in mind. It's already been mentioned, but using losses that you may have, you can offset those against gains. And of course, capital gains tax can die with you. I think there is another opportunity. Sarah just mentioned there that the rate of CGT may change. And I've got an example where I had a conversation with a client of mine who I've been working with for a number of years, where this could have a big impact on them. So we had a discussion on what we could potentially do. Now, this particular client, it's a married couple. They've got a funded share account which has been invested for a number of years. They're lucky enough that they've had gains on that account. The goal for that money that's in there ultimately is to buy a holiday home. It's just they don't yet know when that might be. Mm-hmm. So we've kept money invested with this sort of vague plan that at some point in the future you'll be selling it and using it to buy a holiday home. Because of the rumours in the budget that are coming out that CGT may be increased and perhaps matched in line with income tax rates, we had a discussion about perhaps bringing that decision forward and crystallising that gain now, moving the money into cash, because you know what the rate of CGT is at the moment. So it's a little bit better the devil you know. Mm-hmm. With this particular client, we decided we would do that. We'd bring the tax burden forward, as it were. It's quite a large tax bill, but at least we know what the tax bill is. Mm-hmm. And the money is now held in cash. One sort of side effect of this, positive side effect, is that it's kind of spurred them into action. The plan was always to use the money to buy a property, but it was always one of those, it's later down the line. Dreams are everybody's got them, but actually putting them in place can be quite daunting. Now that they've not been forced, but they've kind of been encouraged to sell, they've now got that cash, they're starting to look for properties, and actually it was quite a nice sort of outcome of that decision-making process. But that only really works where, again, it fits into their wider plan, and an action was taken because they were going to do it at some point in the future anyway. So you've got to be really careful and think carefully before you make these kind of big decisions.
Thank you. I will just point out that the QR code on screen, if you scan that with your mobile phone, that will take you through to the the capital gains tax calculator. We're going to leave capital gains tax there for the second, and we're going to move on to inheritance tax, something else that's also been talked about a lot in the media. Inheritance tax receipts are on the rise, Sarah. What key information do people need to know about inheritance tax, how it works, and whether they may need to consider about loved ones paying less than is necessary?
So inheritance tax is one of those, it's unnecessarily complicated as far as I can see. So it is worth kind of going back into the rules just to kind of lay out kind of where people stand. So we all have a nil rate band of £325,000, and that means that you can give away £325,000 to anyone and not worry about tax. If you own your own property and you're going to give it to your children or grandchildren or great-grandchildren or beyond, it's known as issue, which is one of the many things about inheritance tax which is unnecessarily complicated. But if you're going to give it to issue, then you also get this residence nil rate band of £175,000. So you add them together and you can give away £500,000 free of inheritance tax. So one of the other rules is if you are giving everything to a spouse or civil partner, then inheritance tax doesn't apply. If you do that, then you also give them your nil rate bands, which means that when the second person in a married partnership dies, they will have £1 million that they can give away, which is obviously, it comes as a huge relief to people when they hear £1 million, because they might have been worried that they'd buy inheritance tax, and it can be a huge relief to think, okay, actually it's beyond what I need to worry about, so that's good. It's also worth knowing that it's also worth knowing that you can give gifts during your lifetime, which is a really useful way of bringing down the size of your estate as you sort of go along, which means that it can bring you down below those thresholds. So there's a couple of rules around gifting it's worth knowing. So in each year you can give away £3,000. within your annual allowance, and that's to anyone. You can also give gifts from excess income. Now those rules, the basic is that if you have the money and you're not eating into savings, then you can give that away on a regular basis. I say those are the basic rules. There are more complicated rules, and they include things like the records that you need to keep in order to make that work. And so it is worth checking out what the rules are around that, just to make sure that you're following them all properly and that you're not, no one's in for a big surprise. And the other big one is that you can give away anything of any size to anyone, and as long as you live for 7 years after you die, as long as you 7 years after the gift, then there's no inheritance tax to pay, because that will just fall out of your inheritance, your estate for inheritance tax purposes. And those are really useful tools that people can use as they go along. It's not just got inheritance tax benefits; it's also can be really useful for like passing money down generations. And there can be families where the younger members of the family who are struggling to get onto the property ladder, and this can make a massive difference to them as well. So it's not just the tax, there's also the benefit of giving the gift at the same time as well.
And also getting to see your loved ones enjoy the gift as well, I suppose. So lots of different gifts, and actually there's a big section on our website that's really valuable if people have questions around those different gifts that you can pass on within those IHT rules. Bradley, we're going to come to you and just ask you in terms of what other strategies people can use to really minimise inheritance tax.
Yeah, so it's an area where I have a lot of discussions with clients on inheritance tax, and there are a lot of things that you can do. And I think we've got a slide on screen which I use a lot with clients, and that is that when you're doing something with inheritance tax, you can really put the solutions into two categories. You get the first category where things are relatively easy to do, but they're going to make quite a low impact on your inheritance tax position. And then you've got those things which are much harder, but they're going to have a bigger impact. Starting with the first category, we've got the gifting allowances, which Sarah's just mentioned. So your £3,000 allowance. Mm-hmm. There are some other ones in there, like if you've got a son or a daughter or a grandchild getting married, there's the marriage allowance. Gifts out of surplus income. This is a really useful one which I find in my experience that clients aren't aware of. And not everybody has surplus income, but if you do have surplus income, then it is one which you can just give that money away and it immediately falls outside of your estate. A solution which I've used with clients in the past is if you've got an ISA and a pension, and let's say the ISA is currently sort of surplus to your requirements and you don't need that money at the moment, you can invest that ISA in such a way that it generates an income. That income is then paid to you on a regular basis, and because that's surplus to your requirements, you can just give that income away. It's quite a nice solution because A, you're giving money away and helping your family, it immediately leaves your estate, but also where the focus is more on income than it is growth, it may cap the growth you get on that ISA, which is probably going to be above your IHT exemption as well. Another one is spending more, and again, this in my experience, clients don't take this one into account as much as they should. It's definitely the most fun one of the solutions. And when we say spend more, it doesn't mean sort of put an extension on your house. If you spend £100,000 on an extension on your house is probably going to be worth £100,000 more, so it's not going to solve any problems. This is really spending more on things like holidays, maybe take your family out and off to pay for the meal. It's if those assets are above the inheritance tax threshold, in a way you can see you're getting a 40% discount on whatever you spend, which is quite a nice way to look at it. There's the use of children's savings accounts as well, like junior ISAs and junior SIPs. Pension contributions for yourself is something that people often don't realise. Even if you're not working, you can still contribute £2,880 into a pension, be grossed up by tax relief of £720 to £3,600. That's providing you're under the age of 75. But that money immediately leaves your estate. And if you're a married couple, you can do that for both of you every single tax year, and it just means that you're slowly shifting money outside of a part of your estate which is subject to inheritance tax into part of your estate which isn't, which is the pension. And then one which I don't think is listed here, but you can use the sequential order of drawdown. So thinking about where you take money from to spend, i.e. if you've got ISAs versus pensions, maybe use the ISAs before you use the pensions and use that part. So those are the things which you can do quite often, and they make a bigger impact but over a longer period of time. And then you have the second category, which is much harder to do but much higher impact. And the reason these things are harder is because it invariably involves giving something up, and people don't like to do that. So this involves large gifts, 5-figure gifts, 6-figure gifts. Again, just either making outright gifts. You can use trusts if you want to retain some sort of control. Trusts are a pretty complex area, but they are available. Whole of life insurance is something that a lot of people, again, aren't aware of. This is where you can take out an insurance policy on your life, or if you're married, then you do it on joint lives. And when you pass away, there's a big payout from the insurance contract which can go towards paying the inheritance tax bill rather than having to use assets in the estate to do that. And then business property relief as well, so investing in things like AIM shares is another thing you can look at. Particularly in the second category, they are big decisions. And this is where advice can be really valuable. What you don't want to do is give a load of money away or take out an insurance contract or one of these big decisions without properly thinking through the different scenarios. And I often talk about what if scenarios with clients. You know, what if you give away £100,000 and then you need care? You know, so it's about thinking through the decisions on a longer term basis, and that's where having conversation with an advisor for those larger things is really, really valuable.
And I think one of the things I'd add is you know, you talk about the use of trust and how they can be quite complicated. And one of the you know things, the other things on the easier side is when you've got the junior ISA. And one of the great things about the junior ISA is that you're giving money away today, but the child won't have the money in their own hands until they're 18. So it's a really useful way for you to think, you know, you feel confident that you're giving money away that is sort of safe and protected, well, safe and protected from people spending it, up until the child is old enough to make sensible adult decisions. And you've got that whole period of time to talk to them about money and help them make sensible decisions. So a junior ISA is a really handy way of passing money down the generations that often, you know, people don't necessarily think about the fact that they will have that sort of additional level of control with it too.
Absolutely, and of course if you open that junior ISA when that child is born, you've got 18 years potentially of compound growth from those investments over that time period to really help grow the money. Lots of food for thought there, Bradley. I'm going to try the 40% discount on my parents next time we go out for dinner. I'll let you all know how I get on. So as we wrap things up, Helen and Sarah, I'd like to come to both of you and ask what we really think should be the key priorities for this new Labour government when it comes to driving the nation's financial resilience.
So I think from a pensions point of view, the key thing I think for us is, you know, I've mentioned earlier, pensions are a long-term game and you need a long-term approach to pensions policy. And, you know, we've seen, you know, over the years so much tinkering at the edges of the pensions tax regime, and all that has done is introduce unnecessary complexity, and it undermines people's confidence. You mentioned there about the research that we've done where people refer to pensions as being murky and complicated, and you know it shouldn't be that way. And so what we would really like to see is, you know, any changes to pensions be taken with an overarching view of the whole system rather than tinkering at the edges, and with a long-term view that kind of makes sure that people are incentivised to save for their future and that they're able to navigate the system without fear of being tripped up by, you know, major changes, you know, further down the line.
Absolutely. And Sarah?
I mean, the other thing that we're really sort of keen to see is some certainty. I mean, I think we've all had enough of the speculation now. And I think, you know, there is an opportunity to make some really clear and quick announcements that would be very straightforward and would put a lot of people's minds at rest. I mean, something as simple as saying, for example, we're not going to touch the ISA allowance, for example, because just by not having said that, there's been a rumour has sort of started up as, will there be a change to the ISA allowance? And I think there's a number of sort of key, straightforward announcements that could be made saying, we're not going to touch this, and we're not going to touch that really would put people's minds at rest. So we'd like to see that as soon as possible. The other side of things is the sort of balance between tax raising and encouraging investment. So investment's obviously good for people because it's, you know, we are responsible for much, much more of our personal finances than ever before. We're having to make our own futures. And so it's really important for us for that to be supported through the tax system. It's also really important for businesses. You know, there's a huge amount that's been said about the importance of growth within the UK and how much of that is based on investment to businesses. So actually, you know, by reassuring people that they can save and invest, it means that they will put money into these businesses, which will help growth, which will help that agenda as well. So I think it's, you know, it's one of those things that obviously there is a big drive to raise money through this budget, but it really has to be offset against this, making sure that it doesn't put people off saving and investing.
Absolutely, some great points there. And then last question for you, Bradley. HL's financial advice team are running budget clinics for the first time. Why should anyone listening consider signing up for a chat, either with yourself or one of your colleagues? Can you shed a bit of light on what participants can expect from that 30-minute meeting?
Yeah, sure. So the budget clinic is an opportunity to sit down with a financial advisor. It's really a financial health check. It's about a 20 or 30 minutes, either telephone conversation or video call. And you get to speak to an advisor, you get to choose the topic effectively, and you are the one who decides what we talk about. And really it's a chance to tell the advisor what your objectives are, what your plans are, what the strategy is you're using to get there, and the advisor can then explore that with you, make comment on it, ask questions to perhaps make you think about things you hadn't thought about before, and give you angles to explore and things to consider. It's completely free of charge. There's no obligation to move forward with advice. But if it's determined that advice is something that would then really benefit you, the advisor can talk about what that might cost, what that might look like, the kind of things that we do. So it's a really good opportunity to sit down with an advisor. You dictate the topic and what you want to talk about, and the advisor will then be led by you and hopefully give you some good pointers and move forward from there.
If anyone would like to book one of those free budget clinic appointments with either Bradley or one of his colleagues in the financial advice team, then take a moment to scan the QR code on screen with your mobile phone, and then you'll be able to book an appointment at a time that's convenient for you. So that brings this session to a close. Please do take a couple of minutes to read through the important investment notes on screen. They reiterate that everything discussed was purely information and is not to be considered financial advice. That tax rules can change, and also that investments can fall as well as rise in value. Thank you very much for taking the time out of your day to listen to this session. We do hope that you found it informative. If you do have any questions, then we'd be happy to take those. So please do contact us via the booking appointment with the budget clinics, or you can get in contact via the help desk or by email. Thank you very much for listening. We hope you found it informative, and thank you to Sarah, to Bradley, and to Helen for joining me.